You know, the greatest mistake that people make when it comes to asset protection for real estate is not understanding the risk that exists out there for you. You go to a local attorney or you go to a CPA and they tell you this: load up on insurance. The risk really doesn't exist when it comes to real estate investing. They may even tell you, hey, I've been working with real estate investors for 10 years and I've never once had one sued. Well, just because they haven't experienced it doesn't mean it can't happen. I was working with someone not too long ago, and they said that their local attorney told them they do not need any protection for their rental real estate. All they needed was more insurance. And that to do any additional planning was just a waste of money because they hadn't seen many cases dealing with real estate investors who were sued by their tenants. And I looked at him and I said, well, if you want to follow his logic about not putting forth any protection, then why do you carry insurance for your car? Because if you've never been in a car accident, because he told me he hadn't, then it's really useless to carry insurance. That's a useless expense because if you're never going to be in a car accident, why have it? See, the same rules apply when it comes to asset protection for real estate investors. Just because you haven't seen it, as I stated, doesn't mean it doesn't exist. For example, one of our clients, and he's also a good friend of mine, he's an attorney, he represented an individual who had rehabbed a property. And this individual had built this deck, the railings, and he spaced the railings per code, per the city code for this particular area. So he had to set them the right distance apart. Now, he rented the place to a young couple who had a small child. That small child crawled out on the deck one day and fell through the railings. This individual was sued, and he ended up settling for a lot of money. But I can tell you, the reason he lost that case is because the judge looked at it and said that he was negligent. He argued, well, I built the railing to code. And he said it doesn't matter what the code states, it's what is the foreseeable risk of loss. And just because a code said that 10 inches is sufficient to satisfy the city code when it comes to building doesn't mean that's sufficient to prevent a baby from falling through. And you should have realized that if you're renting to a young couple who has a child, that that's a potential that could occur. So he was held liable in that particular situation. There's other examples too when it comes to real estate. How about toxic mold? Not too long ago, I watched a show on ABC. It was called The Lookout. It might have been 2 years ago now. And the very first episode they had is dealt with these mold remediation experts. See, the purpose of the show was to expose people who are charlatans. And they thought, what better yet to go after than people who talk about toxic mold, these guys that will come in and remove mold spores from your house. Because if you didn't know it, all houses are full of toxic mold. At least that's what they'll have you believe. So what they did is they brought in 2 microbiologists, went through the house, they found no mold spores. Then they rigged the house for sound, and they put in cameras. And then they brought in these individuals that they would call in the phone book who were mold remediation experts, and they asked them, could you walk through this house and determine whether or not there's any mold spores in here? Because the person they presented to these mold remediation experts looked like a young housewife, and she was concerned about her kids. Well, these mold remediation experts didn't perform any type of scientific study. The vast majority of them, 5 out of the 7, just walked around in these rooms when they thought no one was looking, talking on their cell phones. I actually saw one guy sniff a wall. That was the extent of it. And then when they brought him back to show them, what they actually did, because they recommended that she spend thousands of dollars to clean up the mold problem, they brought him back in and they said, well, you recommended that this person spend $10,000 because her house is full of mold. How did you determine that when you spent all your time on your cell phone? Those people are called expert witnesses. Those are the individuals that you will have to deal with if you're ever sued for toxic mold because your tenant can no longer pay the rent. And what better way to get out of it than bringing a mold case against you? Now, I've seen it happen. We've had clients who've been sued for this, and we understand the impact it can have on you as an investor because your insurance will not cover you because this is an environmental claim. So you have to then rely upon your LLC. And in fact, toxic mold is one of the number one complaints that we see more and more from our clients. That is where the tenants are asserting that there is a problem with the property. So this is an area that you need to protect against, and only a proper form, an LLC or a corporation or a limited partnership can provide you the appropriate form of protection because insurance will not cover you. Now, there's other cases I can go into as well. House burns down, client's house burns down, thought she had enough insurance because the attorney told her to load up, don't use an LLC. Well, she had enough insurance to cover her property, but not the adjoining property that was burned down as well or significantly damaged. So that was a situation where this person went into bankruptcy as a result of an attorney's advice who said, just have insurance. So what I'm trying to impress upon you is that you need to do more. That asset protection is a part of real estate investing. And to not put any protection in place is to do so at your own peril, because it only takes one lawsuit. And the question is, when that one lawsuit hits, you're going to wonder, do I have enough protection? Well, I've been with clients who have no protection. I've been with clients who have adequate protection. And I can tell you there's a different mindset there. The people that didn't have the protection, the number one complaint they make is that I wish I would have done this when I was told to set it up, and I would not have followed that other person's advice. Because it's just the fact of the matter is that you're completely exposed when that lawsuit lands, and there's nothing we can do for you at that point, because at that point, anything we do could be considered a fraudulent transfer and undone, because you're under a foreseeable risk of loss that you may lose some assets in the event of that lawsuit or at the conclusion of that lawsuit. So asset protection is important. You need to plan if you're a real estate investor. Now, the next aspect you want to look at is to make sure that you get the right information. And when I say right information, I'm not talking about just accurate information. I'm referring to relevant information, that it pertains to your business. You know, not too long ago, an individual, he's a real estate flipper, wanted to set up a consultation with me to come into my office and discuss his business. And I agreed to it. And I said, before you come in, I want you to give me a copy of your last year's tax return. And I also want you to fill out an asset protection questionnaire where you list all of your assets. So he did this. And when he came into the office, I sat down with him and I said, well, what have you done now thus far for your planning, for your flipping business? And he said, well, I've done nothing. I've been running as a sole proprietor for the last 2 years. And I just recently went to a local attorney and he told me to set up a limited liability company for asset protection. I looked at him, I said, he's right. An LLC is the appropriate entity for asset protection purposes. He's 100% accurate. It will protect you. If something happens with the flip, you're going to be protected. I said, what about taxes? He said, well, he sent me to a CPA. So I went to a CPA, and the CPA told me to have it taxed as an S corporation. I said, why did the CPA tell you to have it taxed as an S corporation? He said, well, CPA said if I make $150,000, I can cut my employment taxes because right now I'm a Schedule C filer. I'm a sole proprietor and everything shows up on my individual 1040 Schedule C, so I have to pay employment taxes on all of that income. But if I have it taxed as an S corp, I can cut that in half because I'll just pay myself a salary, a reasonable salary, and I'll take the rest as a distribution, and that's not subject to employment taxes. And the CPAs told him you could possibly save between $5,000 to $6,000 a year. Accurate information. I said, sounds to me like you got some accurate information from both a CPA and an attorney. He goes, yeah, so I'm thinking about doing this. I said, well, you'd be wrong to consider taking their advice. And that's where he didn't understand where I was coming from, and he sat back with a puzzled look. And I said, the information they gave you is accurate, but it's not relevant because you're a real estate investor who is engaged in flipping property, so you have a primary need, and that need is to have access to capital. And I can tell from looking at your tax return that you're spending about $15,000 to $20,000 a year on average in interest. So that tells me you're using hard money in your purchasing of real estate to flip. Am I not correct? And he goes, yeah, you saw that on my tax return. I said, yep, it's right there. There's your interest that you paid, your interest deduction, that is. And I said, on top of that, I'm looking at your asset protection questionnaire, and what I see here is that you have a primary residence with over $500,000 in equity in it, and you haven't tapped into that. Taken a home equity line of credit to gain access to the equity in your house to use that money in your real estate business. So that tells me that you've gone to a lender and you wanted to borrow money at, 4.5%, 5%. You're trying to work with a conventional lender, and they probably denied you a loan. And he was shocked. He said, you can tell me from my tax return and my asset protection questionnaire, that's what has occurred. I said, absolutely. He goes, that's exactly what has happened. They won't loan me money. I said, well, yeah, it's obvious they won't loan you money because you're a real estate flipper. Banks don't like people who invest in real estate, number one. Everything shows up on your personal tax return. They see it as a Schedule C, so you're not going to get a loan. So now you're stuck using money at 12, 13%. Wouldn't you like to get that down to 4.5%, 5%? He said, yeah, but how am I going to do that? Setting up these structures that the CPA and attorney recommend, will that help me? I said, no, it won't. What you need is a C corporation. And that's where he leaned way back in his chair and he looked at me and he said, "Oh, they told me not to do a C corporation. They told me that they're double taxed and I should avoid a C corporation." I said, "It's because they don't understand real estate investors. I'm an active real estate investor. I flip property. What I provide is not only accurate, but relevant information. Would you not like to have access to traditional financing, to be able to borrow money at 4.5%, 5%? If the answer to that is yes, then you need to go with a C corporation. You need to go with a business that doesn't show up on your 1040. And the way they recommended you structure yourself with an LLC, taxes, and S corp, that's going to show up on your 1040. You're not going to look any different to the lender going forwards than you did last year. You're still going to struggle to get a loan. And point of fact, you even may create a situation where it's even more difficult to get a loan, because now when you go in to apply for a loan, not only will they want to see your individual tax return, but they're going to want to see the tax return for the S corporation. They're going to see the profit and loss, and they're going to want to see the balance sheet. And I would assume if you're running this type of business, you want to expense everything out. You want to net that company out, take as many advantages as you can from having a corporation so that you take money that's not taxable to you. Those are all deductions to your business. He goes, I would love to take advantage of that. I said, well, then think about it then. How's your corporation going to look to a lender then when it shows that it makes no money? It's not going to be a positive thing. So now you've put yourself into a box. When you use entities that flow through to you, if you're a flipper and you want to go out there and borrow money, you box yourself in based upon the way you structured yourself. And that is because the people you're dealing with do not understand your business. By setting up a C corporation, none of that information will show up in your personal tax return. The only thing that'll show up there is your salary. So you pay yourself a nice, healthy salary. When you go in to apply for a loan, you tell them you work for a company, you're an officer in the company, you make $150,000 a year. Yes, you're going to pay a little more in employment taxes, but it's going to pale in comparison to the amount of money you're paying right now in interest. You will save money and you will look better to lenders. That is the difference between accurate and relevant information. You look at your situation and you make a determination as to what do I need from a tax and asset protection standpoint, but also what do I need from a business standpoint? And it takes a professional that understands your business in order to give you that type of advice. And so what I'm going to be doing with you through the course of, through these several courses on asset protection for real estate investors is walking you through different structures that apply based upon your type of investing and explaining to you why you need to set them up this way, because the why is the important part of it. There's so many people out there on the internet that tell you the how, but they don't explain the why. And many times it's because they themselves do not understand it. At Anderson, we work with real estate investors just like you. This is what we do day in and day out. We have a team of professionals, attorneys, tax attorneys, CPAs, financial planners that focus on creating plans for real estate investors to make sure that they not only have accurate structures, but they're relevant for their business.